Laura.
So, before we really get into the weeds today, just a quick disclaimer for everyone listening. Everything we discuss in this deep dive is strictly for market context and intellectual exploration, right?
Exactly. We are looking at the mechanics of the financial system, not, offering personal investment advice or recommendations.
Right. So let's set the baseline for today. Today is Wednesday, April 15th, 2026. And if you are trying to navigate this market, you really have to understand the regime we are currently operating in.
Yeah, because it looks absolutely nothing like the previous decade. We are operating in a profoundly divergent economic regime right now.
Meaning what, exactly?
Well, think back to the 2010s, right? We had low inflation, low rates, very predictable cycles. But today, the global market is grappling with re-accelerating structural inflation, deep geopolitical fractures.
Especially those ongoing supply chain choke points in the Middle East.
Exactly. And simultaneously, we are in the middle of a massive $635 to $650 billion AI capital expenditure supercycle.
And what blows my mind is how that AI supercycle is just entirely defying traditional credit gravity. I mean, historically, when central banks keep interest rates this high, corporate spending dries up.
Right, the cost of capital is supposed to be prohibitive.
But the hyperscalers, the massive tech giants building these data centers, they simply do not care what the Fed does. They are spending billions regardless.
And that collision between a massive technological tailwind, sticky inflation, and geopolitical risk, that is exactly what generated the historic volatility we saw today.
Which brings us to the core mission of this deep dive. The S&P 500 actually crossed that 7,000 milestone today.
It's a huge psychological level.
It is. So we are going to unpack the massive geopolitical relief rally that drove it, break down the surprisingly robust bank earnings that built the foundation, and explore why true market discovery means looking past the algorithmic whiplash.
Right, to understand what's actually happening in the physical world.
Exactly. So let's kick off session one. What set the stage before the U.S. session opened today?
Well, to understand the morning setup, we actually have to pull forward some critical context from yesterday, April 14th.
Right, because the gears were already turning.
Yeah, the broader market had already initiated this massive relief rally when President Trump hinted at a second round of U.S. Iran negotiations taking place in Pakistan.
Just the hint of a meeting was enough to move the needle.
Exactly. That headline alone took the edge off the brutal $110 per barrel oil spike that had been suffocating equities ever since the Strait of Hormuz blockade began.
Because that war premium on oil was essentially acting as this massive invisible tax on the global economy. Suddenly, traders see a diplomatic off-ramp and, the pressure valve just releases.
And the data backed up that sentiment early this morning. At 10 a.m. Central European Summer Time, so that's 4 a.m. Eastern Time today, the International Energy Agency released a major forecast.
Oh, the IEA report. What did they project?
They projected that global oil demand is actually going to contract by 80,000 barrels per day in 2026.
Wow, 80,000 barrels.
Yeah, and that projection pushed WTI crude down significantly, eventually settling near $91.28. If we look at this through a classic macro lens, this is textbook supply and demand elasticity at work.
Okay, how so?
Well, the market was pricing in extreme scarcity due to the geopolitical supply risks, but with peace talks on the table, that supply risk begins to fade.
Right.
So you combine fading supply risk with the IEA actively forecasting contracting forward demand, and the economic models perfectly dictate a swift downward repricing of energy commodities.
Wait, hold on. The models assume the world just snaps back to normal overnight based on a headline.
Oh.
This is exactly where the algorithms misprice physical reality.
How do you mean?
The trading algos treat geopolitical events like the blockade of the Strait as random, unpredictable shocks, like a hurricane that hits and then just passes.
Yeah.
But this is human game theory.
Right, it's state actors.
Yes. It's a calculated high-stakes poker match. The physical naval mines are literally still in the water in the Strait of Hormuz. You cannot algorithm your way around a physical supply chain chokehold?
I mean, the market is pricing in the probability of a resolution because they are sitting at a negotiating table.
But roughly 20% of the world's global oil consumption passes through that specific corridor.
Yeah.
The initial market sell-off a few weeks ago and today's massive relief plunge in oil, they're both emotional overreactions.
Okay, I see your point.
Yeah, the machines are buying and selling headlines, completely missing the on-the-ground reality of what it actually takes to clear a mined maritime choke point.
I concede that the models do assume a frictionless return to baseline, which inherently ignores the physical friction of conflict. Real logistics take time.
Exactly. Months, not minutes.
But, the pre-market optimism wasn't solely resting on oil. While energy was sliding, we received massive structural validation in both the tech and financial sectors overseas.
Right. The semiconductor space had a huge morning. Walk us through that ASML print.
Sure. So at 8 a.m. Central European Summer Time, 2 a.m. Eastern Time today, ASML reported their Q1 earnings. They posted 8.8 billion euros in net sales.
That is massive.
It is. Now, their shares actually sank initially due to some short-term valuation concerns. But here's the critical mechanism. They significantly raised their 2026 outlook specifically on AI-related demand.
Yeah, and for anyone listening who might not follow the semiconductor supply chain, ASML is the absolute linchpin. They hold a monopoly on these extreme ultraviolet lithography machines.
The ones needed for the most advanced chips, right?
Exactly.
Yeah.
In plain English, they make the highly complex bus-sized machines required to manufacture AI chips. So if ASML is raising their forward outlook, it proves the hyperscalers are still placing massive multi-year orders.
Yeah, it essentially confirmed that the AI CapEx cycle is effectively bulletproof right now. And that realization sparked a massive pre-market rally in U.S. tech futures.
And then the banks chimed in?
Yes, the major U.S. banks stepped in to validate the health of the broader institutional economy. Building on yesterday's mixed results, we saw Bank of America, Citigroup, and BlackRock post massive Q1 beats right before the opening bell.
At what time did those drop?
Right at 6:45 a.m. and 7 a.m. Eastern Time. Citigroup hit $24.6 billion in revenue, and BlackRock saw a staggering 46% rise in net income.
Which is wild because high interest rates are theoretically supposed to crush economic activity, right? If you're looking at these banking beats, you might be wondering how they are pulling this off.
That's the volatility, isn't it?
Exactly. When the markets are swinging wildly based on geopolitical headlines, institutional clients have to constantly adjust their portfolios, hedge risks, trade in and out of positions.
And the banks act as the toll collectors on all that movement.
Right. So, to wrap up session one, European tech basically confirmed the physical demand for the AI supercycle, and U.S. financials provided a rock-solid fundamental floor of profitability before the opening bell.
Which sets us up for a fascinating regular trading hours block.
Let's take a quick breather and then dive right into the fireworks of the U.S. day.
All right, moving into session two. What moved markets during U.S. trading hours?
Well, that calm, calculated foundation we just talked about, it completely vaporized the second the opening bell rang in New York.
It really did. The dominant catalyst of the entire U.S. trading session hit right as the market opened at 8 a.m. Eastern Time.
The Trump announcement.
Yes! President Trump officially announced that the U.S. is preparing to actively wind down the conflict with Iran, stating that a comprehensive deal is possible soon.
And the reaction across the board was just instantaneous and violent.
We witnessed a massive cross-asset rotation. The VIX, which serves as the market's primary fear gauge, it plunged dramatically down to 18.36.
A huge drop.
Yeah, and that sudden evaporation of fear pulled sidelined capital aggressively back into risk assets, which is what ultimately launched the S&P 500 to a record-closing high of 7,022.95.
Breaking that 7,000 barrier.
Exactly.
Yeah.
And if we analyze this through the efficient market hypothesis, the market mechanisms function perfectly. The collective intelligence of the market instantly recalculated the probabilities.
Here we go with the models again.
Hear me out. A peace deal means a lower probability of structural inflation and a lower probability of total supply chain collapse. That logically reduces the equity risk premium, making equities instantly more attractive.
But the intrinsic economic value of America's 500 largest companies does not miraculously surge by hundreds of billions of dollars between breakfast and lunch.
The price action was undeniable, though.
The price moved, sure, but the intrinsic value of those underlying businesses didn't. This wasn't a perfect mathematical recalculation by cool-headed investors.
What was it then?
It was a liquidity vacuum. You had thousands of traders and algorithms heavily shorting the market, betting on a broader Middle East conflict. When the peace headline hit, they got caught offside.
So they had to cover.
Exactly. To close a short position, you are forced to buy the stock back. It creates a violent emotional short squeeze. It's not market efficiency. It's a forced stampede through a very narrow exit door. I will concede that the concept of bounded rationality really comes to life in these moments. Investors aren't making perfectly logical, long-term mathematical decisions with all available facts.
No, they're making panicked, split-second bets based on a flashing headline.
Right. True price discovery takes days, sometimes weeks. Today's intraday whiplash definitely highlights market emotion over mathematical precision. But we also have to look at the macroeconomic data that was actively pouring fuel on that emotional fire.
Yeah, the no landing narrative got some serious backup today.
Exactly. For those unfamiliar, a no-landing scenario means the economy doesn't slip into a recession, but it doesn't cool down enough to defeat inflation either.
It just keeps growing at a hot, elevated pace.
And at 8:30 a.m. Eastern Time, the data perfectly supported that. U.S. import prices came in surprisingly soft, rising just 0.8%, which eased imported inflation fears.
But locally, things are still running hot.
Very hot. Concurrently, the New York Fed's Empire State Manufacturing Index jumped to 11.0. This perfect cyclical setup is exactly what kept the 10-year Treasury yield elevated at 4.28% today.
But, the economy isn't booming for everyone. At 10 a.m. Eastern Time, we got the April U.S. Homebuilder Confidence Index, and it fell to a reading of 34.
Which is the lowest level since September of 2025.
Right. And that localized weakness is being driven directly by 30-year mortgage rates hovering near 6.37%. It proves the high-rate environment is still causing massive economic friction for the average consumer.
It really capped the small-cap indices today, even as the S&P soared. And we also received a stark reality check regarding that persistent inflation from the central banks.
Oh, from the Bank of England, right.
Yes. At 12:37 p.m. Eastern Time, BOE policymaker Megan Green warned that inflation risks stemming from the Iran conflict remain, quote, paramount.
Which brings us right back to the physical reality of the naval mines. Until those shipping lanes are physically cleared, the supply chain is compromised.
And despite her hawkish warning, gold still surged to $4,831 an ounce today.
A classic hedge.
Exactly. So to wrap up session 2, the U.S. session was effectively a massive tug-of-war between profound geopolitical relief and the lingering sticky realities of high interest rates.
All right, let's take a quick pause before we dive into the corpus specifics.
That's good.
Okay. Moving into session 3, what is our corporate events recap and what should we watch next?
Well, this incredible disconnect between the digital exuberance of the AI boom and the physical friction of the real world brings us right to the biggest corporate story of the day.
Right, because capital expenditure isn't just lines of code. It has to manifest in the physical world.
And Oracle proved that today. Extending their momentum from an initial announcement on April 13th, Oracle shares surged 4.18% today at 9:30 a.m. Eastern Time.
And it wasn't because of some software update, was it?
Not at all. It was driven by tangible progress on a massive 2.8 gigawatt fuel cell deal they struck with Bloom Energy to power their new AI utility suite.
2.8 gigawatts. I mean, a single gigawatt is roughly enough to power a mid-sized American city. Oracle is procuring enough independent power to run multiple cities just for their data centers.
It's staggering.
This is what I call finding a hopeful edge as an everyday investor. Look, the algorithms will blindly bid up any software stock that simply mentions AI. But common sense investors recognize the physical limits of the world.
The power grid is the bottleneck.
Exactly. AI requires unprecedented electricity. Investors who realized the grid was the weak link found their edge by looking at alternative energy deals like Oracle and Bloom Energy, while the market was distracted by the software layer.
It's a perfect demonstration of how market inefficiency provides genuine opportunities.
It really is. And the absolute madness of ignoring the physical world while celebrating digital highs was perfectly captured by the trading desk today.
Oh, the closing bell joke. Let's hear it.
All right, here it is. The S&P 500 just blasted past 7,000, proving that the only thing expanding faster than Oracle's AI power grid is your retirement account. Even the home builders aren't sweating their drop in confidence today because with these record highs, we can all just comfortably live inside our brokerage portfolios. Ring that closing bell and let's toast to peace, plunging oil prices and artificial intelligence making us all look like financial geniuses.
I mean, it is genuinely funny because it hurts a little. The exuberance out there right now is palpable.
So true. But what do we actually need to watch over the next 24 hours to see if this holds up?
Well, we have a strict checklist. Number 1, the March U.S. retail sales data release.
To see if the consumer's actually still spending.
Right. Number 2, the April Philadelphia Fed Manufacturing Index. Number 3, U.S. initial jobless claims.
Okay, the standard macro pulses. What else?
Number 4, Morgan Stanley's Q1 earnings report. We need to see if they captured the same volatility revenues as Citi and BlackRock. And finally, number 5, the official U.S. Iran diplomatic meetings in Pakistan regarding ceasefire terms.
That diplomatic meeting is the absolute linchpin to this entire rally.
Yeah.
If those negotiations stall, all of that algorithmic relief we saw today will unwind just as violently in the exact opposite direction.
Absolutely. So before we sign off, I want to leave you with a final thought to mull over. If markets are pricing in a perfectly smooth, no-landing scenario based entirely on an AI supercycle, what happens to global liquidity if the actual physical power grid cannot keep up with the algorithms?
That is the multi-billion-dollar question. Let us know your thoughts and how you're navigating this tape down in the comments.